Hello, everyone. Thank you for joining today, and more people will no doubt join, but want to just get this session started. For those who may not have been to one of our live webinars yet, my name's Janelle Aldred, and I'm one of the Deputy Chairs of Women in Journalism. And thank you for joining this webinar session today, a really important one for anyone who is self-employed or also thinking about becoming self-employed or about to start being self-employed, and it's all about tax. So we're coming towards the end of January, and for some people this is a very frantic time of year as we try to collect all of our receipts and get our tax returns in. So today, really pleased that we could be joined by some tax experts who are going to help us get our affairs in order, especially if you're midway through doing your taxes for the end of this year or thinking about how you can be prepared for next year. So really glad to have Barry and Andrew from HW Fisher here today, old friends of Women in Journalism, and they're going to give a really insightful talk for us today about how we can do all things tax. Now, before we get into the session, there is a chat box. So first of all, would love to see where you're all joining from today, whether or not you are self-employed, whether you're about to be self-employed, whether you're mid-tax. So we'd love to see in the chat who's here, so we get a bit of a sense of who's in the room. And also, if you could please put your questions in the Q&A box, just because it's a bit easier for us to see the questions away from the comments. But do say hello in the chat. We're really glad to have you here. And do put any questions as we go along in the Q&A box so they can be answered super efficiently. So that's all from me. I'm going to hand over to Barry and Andrew for the rest of the session.
Thank you, Janelle. Very nice to meet everyone. Looking forward to this session. We'll keep it hopefully nice and short and sweet, 30 minutes or so. If we don't cover all the topics, we will be available. The slides will be available to be shared later on. So please do feel free to ask questions. Janelle said in the chat box, and we'll help as best we can. So I'll pass over to my colleague, Barry Kernon now.
Good morning, all. Janelle, could we have the next slide, please? That doesn't tell us a great deal, but it is tax matters for journalists, and you shouldn't all be doing your tax returns in January, of course, but we'll talk about that a bit later. Next slide, please. These are the main headings. We've only got half an hour, so I'm going to need to go at a bit of a pace to cover them all. Tax Basics talks about things like what a tax year is and a few helpful things, what to do when setting up in business, what constitutes income. We've covered a few allowable expenses on one slide and talk a little bit about some, a little bit about capital allowances. We've noticed quite a lot of journalists going overseas to work, so there's a slide on foreign tax, a little bit on VAT. Making tax digital, MTDs coming for us all, so there's a little bit about that, although it's not going to affect many people at the moment except VAT-registered people, and a tiny amount on whether to operate through a company or not. Next slide, please. So, the tax year strangely covers the year to 5th April. It's the only country in the world which has this year end, so it causes some difficulties when dealing with other countries. The tax return covers all your income. We have quite often get questions from freelancers asking if the tax return is just for their freelance income. No, it's not. It's you have to include everything, all income from all sources. So if you've got a salary, you have to put that on, pensions, investment income, as well as your self-employed income. It all gets added together. And then the tax-free personal allowance of 12,570, which has been fixed for a number of years, the so-called fiscal drag, is then deducted from the combined total of income in order to fix the rates of tax that apply. For those lucky enough to be over 100,000 in income, there's a loss of personal allowance above that level, which creates a tax rate of effectively 60% between 100,000 and 125,000. So that's an area where you might be wanting to reduce the income in various legitimate means, including perhaps paying pension contributions and that sort of thing. The tax is above the 12,500. tax is at 20% up to about 50,000, then it goes to 40%, up to 100,000, and so on. So a graduated scale, and we're noticing a number of changes tightening up, where the 45% rate now hits at 125,140 rather than 150,000. All sorts of ways of increasing our liabilities. So when the tax return is more or less ready, you'll be able to see on the calculation that you're being given credit for any tax you've already paid on account. So PAYE tax will have been deducted from salary and some pensions. And if it's not there on the calculation, it means you've forgotten to put it in on the employment page or in the body of the tax return in the case of pensions. Savings and dividend allowances, there are exemptions for interest and dividends, which are gradually being phased out, but there are some exemptions that you will notice will appear on your tax calculation. Next slide, please. So when setting up, when you first start as self-employed, you have to register. There are two processes for registering. One is for self-assessment and the other is for national insurance. You need to do both registrations in order to ensure that you get credit for any national insurance contributions you're paying. Sometimes they slip through if you don't register at this stage. The national insurance employees pay is class 1. Self-employed people currently pay class 2 and class 4. Class 2 provides your state pension. Class 4 is just a levy. It's not really a contribution at all. It's just another form of tax. The level at which class 4 applies has been increased gradually. That's now up to in line with the income tax 12,570. The same applies to class 2, and we understand from the autumn statement that class 2 is being abolished completely, and there are quite a lot of changes coming up generally. But for the tax year that you're all dealing with, 22-23 at the moment, class 2 and class 4 liabilities will be calculated in there together with your tax liabilities. And as it says there on the next bullet point, consider putting money aside to cover potential liabilities. You'll have a liability on the 31st of January for the year 22-23. And then if your tax is over £1,000, you'll be asked for a payment on account for the current year, 23-24. So if you have a tax bill of 2,000, you'll have to pay 2,000 plus 1,000 on account for the current year, and a second 1,000 on account is due on the 31st of July. So it's obviously a good idea to put money aside, and the higher the income, the higher the tax hit, and particularly in the earliest year, where your first year you don't pay for quite a while, and you've got a surprise payment on account. It's a very good idea to do your tax return earlier, so you know well in advance what these bills are going to be. The record keeping is important. One thing important to take from this talk is keep good records, because if there are any inquiries from HMRC and the records are bad, they will try and disallow expenses and charge you penalties for being late. The records can be on paper, they can be on Excel spreadsheets, they can be in digital software. And with MTD making tax digital coming in April 26 for everybody, we're gradually encouraging people to start using digital software to get used to it, because it's going to be used by many people at that stage. Digital software lifts information from your bank account, so it's a good idea to have a separate bank account. It doesn't have to be called a business account, but a bank account for your freelance earnings, so that account is contains the information that's lifted into your tax return, and it's separate from private items which don't go into that account. It makes the process much less messy doing it that way. Next slide, please. So just some examples of what is taxable. More or less all these items are, as obviously any articles and columns you would include. For any of you who are also authors, I mentioned book advances. Obviously, their income, tax treatment of those varies rather. You need to work that out sometimes depending on the progress made with the book. And royalties are all taxable. PLR, public lending right, for any of you who have published books, and borrowing, that's taxable but not vatable. And the ALCS photocopying royalties, etc., need to be included. For journalists, reimbursed expenses is quite an important point, and per diems, quite a lot of people think you can ignore those because they're not taxable because they are simply represented by the expenses, but they should be included because they are turnover for income tax and also for VAT, and must be shown, and VAT is chargeable on those if you are VAT registered. They're not, you don't necessarily have a tax liability as long as the expenses that you've had reimbursed are tax deductible. And of course, any other writing income. The profession of writer is an indivisible one. So any income you earn as a journalist is included, as is anything from authorship or poetry or copywriting. Any sort of writing is lumped in together. Next slide, please. Yes, the general rule on expenses for freelancers is that they must be incurred wholly and exclusively in the course of the carrying on of the profession. Most expenses are allowable in one form or another. Main exception is entertaining, which is never allowable. And there are restrictions for clothing, for example, and other items that where there may be a duality of purpose or private use. So we've selected a few headings there where there is a mixture of usage, business and private. So use of home, for example, HMRC are fairly generous in their attitude to how this is calculated. They did have at one point a number of examples on their website as to how you could do it, how many rooms there were in the flat, or in the house, or what sort of square footage you had, or what sort of space was taken up for work. So you need to have a rationale for your claim. A simple example would be you have a room that you use as an office, and you have two other rooms, which are bedrooms and 2 reception rooms. So you've got 5 main rooms. We ignore kitchen and bathrooms, etc. So on that example, you've got a room that you're using. If it's furnished as an office, then you can claim 1 out of 5, 20% of all the costs relating to that room for 365 days a year, because it's your office, and whether you're in it or not, you can make claims for the running costs such as mortgage interest, rent, council tax, buildings insurance, contents insurance, water if metered, repairs and decorating, and so on. You can also claim for lighting and heating, but these claims need to be based on usage. So the number of hours you spend in the room in a typical week would be used as a sort of basis for your charging. It's a good idea to work that out for a period of a couple of months or something, so you've got a sensible percentage to claim, and they may ask how you've worked that out. In other cases, if you've got a studio flat, you might end up claiming for 20-25% of the basic costs and lighting and heating, again scaling the lighting and heating down to time actually spent working at home. It's all a question of percentages, really, that sort of claim. Traveling and subsistence. Traveling where you have a trip. If you decide you're freelance journalist, you're going to write about the North York Moors, a feature, and you go off there to do your research, decide to have a week, and you spend a couple of days researching and 3 days relaxing as a break. You can claim all the travel costs. You can only claim 2 days worth of accommodation. You have to scale that down because it's only 2 days work. Subsistence would also be, it's the additional cost of eating while away from home, while working away from home. So you'd claim that for 2 of the 5 days. These expenses are expenses where there's a duality of purpose, but HMRC are prepared to agree an apportionment between business and private use. And the same applies with motor expenses. You can claim a mileage allowance, 45 pence a mile, up to 10,000 miles, 25 pence thereafter, or you can claim the business proportion of the total costs of the car, petrol, insurance, repairs, servicing, and so on. You need to record your business mileage for both those methods. You need to record the total mileage where you're claiming a proportion of the total costs. You need to decide on which route you're going to take when you first start freelancing. And you can then, if you go for the mileage allowance, you have to keep using that till you change the car. Then you can review it. If you decide you want the other method, you can swap at that point. They won't allow you to switch from one to the other, so you can't claim repairs in an expensive repair year and then go back to the mileage allowance the following year. The mileage allowance is deemed to cover pretty well all the running costs of the car or vehicle. And in addition to those, you can claim road tolls, parking, that sort of thing, which are not included in the mileage allowance. If there are expenses where there's a significant personal element, you need to apportion. So if, for example, you use television quite a bit for work, but also personally, you should be able to claim a proportion of television expenses. For example, parliamentary channel for some journalists, or travel channel, and so on. There has to be a sort of logic to that sort of claim. Okay, next slide, please. Won't spend too much time on this. Capital allowances, purchases of assets, equipment, and so on. These are not expenses, although they may be expensive. These are subject of capital allowances claims, and these go in a different box on the tax return. So if you buy an item in any given tax year, buy a laptop, for example, you can claim up to 100% of the cost of that laptop. Don't have to claim it all. If you'd be wasting allowances by doing so, you can restrict the claim to a smaller amount if you want to. And that the amount of the cost of the item goes in the annual investment allowance box on the tax return. AIA stands for that. There's a separate box for that on the self-employed pages of the tax return. Anything else that if you have items you've brought forward from the past that you haven't claimed in full, you can claim 18% on those. So when you first start, for example, you may already have a laptop and a desk and a lamp and a filing cabinet and so on. So you add those all up, get to a total cost of those items, which is called the pool, and you take 18%, or again, up to 18% of that. And then you claim 18% of the reducing balance year by year until it gets down to £1,000. Then you can claim the £1,000 at that point. WDA is writing down allowance, which is the 18%, and with cars, they're still writing down allowance. It's based on the CO2 carbon dioxide emissions rating. And as I mentioned, previously purchased, also inherited assets. If you've got something, an antique desk, you might want to consider claiming. on that based on market value. That's possible, and that's the 18% rate applying. Next slide, please. Where work is done overseas, journalists actually going abroad, very often there will be tax deductions. In some countries, it's possible to recover some or all of the tax. So it's worth checking in those countries if that's possible by putting in a tax return. Sometimes under the double tax agreement with certain countries, it's possible to reduce the tax payable by putting in a claim under the double tax agreement. And so you would need to get a form from HMRC to claim that, and it goes across to the paying company in the other country, who send it to their tax authority, and they get authorized not to deduct or reduce the amount of tax for the future. It's a bit of a messy process. HMRC are very slow at everything and can take months and months to get these. Very often it's worth getting a certificate of tax residence, because sometimes that works in other countries, even if it's not strictly speaking the right form. It's very often quicker to get that. Useful tip sometimes. Okay, next slide, please. Okay, the VAT. We're following Brexit. We don't have any involvement with VAT outside this country, as it were. So if you have income from foreign publications and UK publications, then you can ignore foreign publications in arriving at your turnover figure if you're looking at your, or you're being near the 85,000 compulsory registration limit for VAT. If you do hit that, it's 85,000 in any 12 consecutive months. It's not a tax year or a calendar year, it's a rolling thing. So if you're getting close to that, you need to check it each month. Again, it includes reimbursed expenses. And once you hit the 85,000, you have 30 days in which to register from the end of that month. And there are, of course, penalties for being late, as there are with every form of tax these days. The forms are, nowadays, it's all digital. It's compulsory filing by MTD. It's a quarterly process. You can register voluntarily, and generally you'll save money by registering because you recover all the VAT on your expenses. Some people have more expenses than others, so it's sometimes the equation is whether you want to spend time on doing the claiming or not bothering because it takes too much time and the amount involved is not great. It's important to remember that when you are self-employed and VAT registered, any self-employed income of any sort is VATable. So if you're a journalist and window cleaner as well, you have to charge VAT on all your income. Domestic customers won't be impressed, no doubt, with that, but that's what the rules say. The records must be digital. You can use a spreadsheet such as Excel if you want to, and in conjunction with bridging software, which will enable you to file digitally. There are hundreds of companies that are registered with HMRC to deal with digital filing, mainly for income tax, which isn't available yet. But the one thing common to most of them, well over 500 last count, is that they all charge a monthly subscription. Next slide, please. So this is Making Tax Digital, MTD. Comes into effect in April 26. It's been deferred 3 or 4 times already. We are assured it's not going to be delayed again, but I wouldn't bet on that personally. But it's every self-employed business and also people with lettings income may come into this net. They've announced recently that from April the 26th, the turnover at which you have to start this sort of recording is 50,000. That's a big increase from the previous proposed figure of 10,000. So it's been relaxed quite a lot. That means a lot of people will fall outside this. So those of you who are employed and self-employed, perhaps whose self-employed income is going to be less than 50,000, then you won't need to join MTD. Otherwise, registering will be compulsory at that level. In the 26-27 year, it's 50,000 turnover, and after that, it goes to 30,000. Probably the level it'll stay at quite a while, I should think. Everything has to be recorded digitally. Software and bank accounts linked to software will be the way forward. We've got early adoption advised. We've been saying that for a while now, but of course it's been put off for a couple of years, so probably don't have to do it too much too soon, but maybe have a go at it from April 2025 to get into the habit of doing it before it goes live in April 26. A suggestion. Next slide, please. This sort of thing goes in and out of fashion. Gordon Brown introduced an exemption from tax, corporation tax of £10,000. Hundreds of companies were formed as a result. Then that got withdrawn, and then it was beneficial to operate through a limited company because you didn't have to pay national insurance. So George Osborne introduced dividend tax. So we now have dividend tax at rates of up to 39%. So it's not necessarily a good idea. Broadly speaking, we never recommend a company below a turnover of about 50,000. They work for people who want to share income with a partner or spouse. That's quite a useful vehicle for that. Or if you're going to get large amounts of money coming in and you want to treat companies as a money box, that can work. But if you just want to collect the money and then draw it out again, you may end up paying more tax than you would otherwise as a freelance. So care is needed. You have to be careful about using companies at all. There's more hard work with them. Separate bank accounts and so on. The accountancy fees go up because of the statutory accounts that are required. So you have to weigh those things up to see whether it's worthwhile. I mentioned in their contracts and copyrights, for anybody with a book contract, for example, some journalists do have, it's very dangerous to assign copyrights where the book's nearly completed, where there's a book deal on the table or it's been written, because there's an income tax liability on assigning. So you can end up paying income tax on the advance figures on which the market value is based, and then the company pays tax on the same amounts in due course. So there's an element of double taxation that's very much worth avoiding. Professional advice is needed with that. Don't do that on your own. Do we have any more slides there? Oh yes, that's a commercial. Don't know if Andrew has any comments on that.
Well, only because I've been answering the now 37 questions that have come up so far. I'm on the 38th one now, so no, it's all been well. I think you managed to do it in very good time with a minute to spare. So, Harry, it's been really helpful, and I have answered most people's questions. If you can, maybe just go to the next slide if you don't mind, just which shows Barry's contact details and email address. And as I think she mentioned at the beginning, we will make sure that the slides are available and sent round. And then if you do have any further questions you'd like to ask, please feel free to get in touch and we'll try our best. Albeit, just be aware that obviously the tax deadline is the 31st of January, so we are very busy at the moment answering clients' queries. But if there's further queries that you do need, we're happy to help as much as we can.
We do have an authors and journalists tax guide available as well on our website. It can be sent round to members if that's required.
Wonderful. So I hope that's been useful.
No, yeah, it has been super useful. Thank you everyone for coming, and we're going to end the webinar now. In a couple of days, we'll send around the slides. We'll also send around the link to the handbook, which is amazing. And someone said the Q&As. We will try to get those for you, but we were answering individual specific ones. So I would suggest hopefully just copy and paste it quickly if you put a question in. But my personal definitely thanks to you both, Barry and Andrew. It's been an amazing session, and thank you so much for your time. Thanks everyone for joining today. Thank you.
Thanks. Bye-bye.
Bye.